Hi there, I'm Murray Dawes, the editor of Slipstream Trader. Over the past few days and weeks, you've been hearing about some great investment ideas and themes for next year from my colleagues. Look, I agree wholeheartedly with the underlying theme of instability within the current financial system and the need to factor this into your current investment plans. But as a trader, I'd prefer not to stray into the area of long-range forecasting, but instead stick to my knitting, which is maintaining a focus on execution. So in my brief remarks, I'd like to make 3 simple points that I believe can help you trade more safely during extreme market conditions and that need to be understood in formulating a robust trading strategy. And the 3 points are pretty simple. Number 1 is that your emotions drive your behaviour. You've got to understand how your hope and your greed and your fear can drive your decisions. Also, you need to be aware of the things that are beyond your control. And also, you need a trading plan that's going to avoid flying your plane into the deck of an aircraft carrier. I'll explain that more later. Now, you should know that the first 5 years of my career was spent in the pits and on the phones on the Sydney Futures Exchange trading floor in the early 90s. Now, I have no doubt that that experience shaped my perception of markets and trading. And what it taught me was that your own psychology can really be the linchpin between success or failure as a trader. Now, building an effective strategy needs to take this into account, whether you're an investor or a trader. And to illustrate this point, I'd like to take you through an actual trade I made a few years ago during the crash. Now, coming into that period, I'd been a pretty determined bear, and I've been a bear for quite a few years, and had been trading the market from the short side, leading into the collapse of Lehman's. And I'd been trading pretty well in the months before then, and had pretty much caught most of the fall between June and July of 2008. I'd booked about 70 grand from that period and was feeling really confident that there was more to come. So I decided to invest 15 grand into 30 short-dated E-mini S&P 500 put options with a strike price of 1200 and had an expiry date of the 19th of September 2008. Now, on the chart that you can see there, that 19th of September will be 2 days after the edge of that chart, and you can see where Lehman's collapsed was on the 15th of September, 4 days before then. Now, my plan was to continue rolling over any profit that I made into new options, or if they expired worthless, to buy more for the next expiry, because I thought there was a crash only weeks or months away. Now, a simple explanation of a put option, for those that haven't used them, is that it's just a bet that the price of the security will go down, but that bet expires on a certain day. In this case, the date of expiry was the 19th of September. Now, if the price was actually lower than 1200 on that date, and 1200 being that line across the chart, I made $1,500 US for every point that the S&P 500 was below 1200. Now, my options were nearing expiry when Lehman collapsed on the 15th of September, and the market started to sell off really hard, and the value of my options started to shoot skyward. Now, I started to get pretty excited at this stage, because it really did look like the market was about to crash. And my plan had been to hedge half of the position when the price got down to 1160, so that I could lock in half of my profit. Now, to hedge the position, I had to buy 15 E-mini futures. That's the S&P 500 futures at 1160, and you can see that point on the chart there. Now, when it hit that price on the 17th of September, my option position was worth about 60,000 US dollars, or 75,000 Aussie, based on the exchange rate at the time. Now, by hedging the position, I'd basically locked in a little less than 40 grand. That's Australian dollars, less the cost of the options. So basically from there, my worst outcome was that I was going to make $23,000 profit, which is better than a poke in the eye. And as I said, that was going to be my worst outcome from there. The option position was still worth 80 grand. So every other outcome would have given me a higher profit than that worst case scenario. Now, the day before the expiry of the options on the 18th of September, trading started badly. It fell off a cliff from the open and looked like it was on the edge of literally crashing in that morning. Now, it was 3 a.m. in Australia at that time, and I was watching the market fall like a stone, and I knew that I was going to make an absolute killing that night. But since I'd hedged my option position, I was now only making 750 US a point, rather than the full 1500 US a point. Now, I felt certain that the market was toast, and the dollar sign started flashing in front of my eyes. If I just dumped my hedge, I'd be exposed to the whole position and would be making 1500 US dollars with every single point fall in the market. If it crashed, well, I could be up another 50 grand by the morning or more. The further the market fell, the more money I'd make. And even if the market managed to turn and rally a bit, well, it wouldn't hurt me much. The options expired the next day, so I was sure I was home and hosed. So at 3 a.m. on the 18th of September, I sold out the 15 S&P futures that I had bought to hedge my position and went to bed safe in the knowledge that I was a genius. Started planning a trip to Paris in my head to celebrate. The next morning, I woke up to this. At 6 a.m, while I lay sleeping, US President George Bush announced the TARP 1 bank rescue plan, stealing about $800 million from US taxpayers and giving it to the banks. The markets reacted so aggressively that the S&P 500 rallied nearly 14% by the open of trading the next night when the options expired. It was the largest one-day percentage move in the history of the index. That's what I mean by extreme. Needless to say, my option position, which had been worth over 100 grand Aussie when I went to bed at 3 a.m, was now worthless at 7 a.m. when I woke up to check the market. If I had held on to my hedge of 15 futures from 1160 by the open of trading the next day, I would have been up about 75,000 US, which is nearly 100 grand Aussie, on the futures position alone. So by closing the hedge down at 3 a.m. that morning, I'd cost myself the whole lot. As you can imagine, I was more than a little upset by this development. To cut a long story short, I watched the market crash without having a position in it over the next 3 weeks, and even managed to lose more money as my mental state deteriorated. If I'd managed to roll over the option position as I wanted to do, the profit at the bottom of the crash about 3 weeks later was approaching $500,000. But instead, I actually ended up losing money. Now here's the first important point I wanted to make. Don't be greedy. In trading, it is always your mistakes that teach you the most, and this one was a doozy. You can trade successfully in an extreme market, but if you allow yourself to be overcome by greed and trade emotionally, you'll probably blow yourself up. And if you don't blow yourself up, someone else might do it for you. Now we may tell ourselves that we aren't greedy or hopeful or fearful, but in the end those emotions will reveal themselves in the extreme moments. Therefore you have to understand that it is how you behave in the extreme moments that counts, whether you're an investor or a trader. For me it was that moment at 3 in the morning when I felt invincible that led me to acting outside of my trading plan. In the cold light of day, it's simple to see that it was outrageous to let go of the very strong position that I'd put myself in the hope of making more money, when the win was already a good one. But at that moment, at 3 a.m, my rational brain was not in control. It's imperative that we accept that this can happen and create trading rules that take it into account. That brings me to my second point I'd like to make. Be aware of the things that are beyond your control. There are a lot of them, and any one of them can bring you to trading grief. Today's markets are the most manipulated and interventionist markets I've ever seen. The governments and central bankers of the world are doing all in their power to keep markets afloat with your and my money. Bush announced TARP 1 on the afternoon before option expiry. They knew that announcing it then was going to give them the biggest bang for their buck due to the huge gamma in the market the day before expiry. They were deliberately attacking traders who were short the market by announcing it then. The risk of intervention increases the worse the situation gets. You have to include this risk in your trading plans. All of my trades now are made with this intervention risk in mind. Now, my third and final point is ensuring you have a trading plan that avoids flying an airplane into the deck of an aircraft carrier. Now, what I mean by that is that you can't let extreme markets turn you into a kamikaze trader, a self-destructive trader. After I'd made my mistake on the eve of TARP intervention, the destabilisation of my mental environment led to a series of mistakes that spun out of control into a series of reckless trades. For example, in golf, you can easily lose control after you whack one in the water, end up shooting 3 triple bogeys on the next 3 holes, because you're thinking about the ball in the water and not what you need to do to make the next shot a winner. In trading, one error can lead to more errors. Your trading strategy and plans need to accept that this can happen and attempt to eradicate it, or at the very least, control it. You have to remember that anything can happen and does happen in the market. You can feel certain that an outcome is impossible, but then it ends up happening. Who would have thought that the 18th of September 2008 was the night that we would see the biggest ever percentage move up in the markets? Certainly not me, but it happened and I got shafted. So your trading plan needs to respect the market and its ability to constantly wrong-foot you. At Slipstream, I've built my technical trading system around these psychological pitfalls of trading. In an extreme market, the 3 simple rules you should keep in mind are: understand that your emotions will take over in extreme moments. Make a plan that controls them. Be aware of what's beyond your control. and don't allow one mistake to turn you into a kamikaze trader. Now look, I didn't spend a lot of time talking about my own theory of price action and how I use it to identify trades. But if that's the sort of thing you're interested in, I recommend you go to YouTube and search for Slipstream Trader. I've been recording a weekly market analysis for most of this year. You can watch those videos to see what I think of the markets right now. And feel free to leave a comment or a question. Thanks very much for listening.